Our next guest says it's still too soon to see the impact across the economy. Piper Sandler chief strategist Michael Kantrowitz, he's gotten it right on our air for the past year, telling investors in January to buckle up for a long recession, saying stocks won't bottom until PMIs do, and it could be a long 2-year road ahead. Today, he says we have all three ingredients in place for a hard landing. Mike, it's good to see you again. Welcome.
You too. Hi, Kelly. Hi, Tyler.
About the only thing I think I can fault you for is being early at this point, because we all thought perhaps by now the labor market and jobless claims would be cracking. What's really interesting is to see the way that we're starting to see credit markets seize up even without that happening. So what's your take?
Yeah, I mean, we've seen, as you mentioned, we've got a lot of problems that are starting to pop up. We've got knowns and unknowns, and I think there's a lot more. And those three ingredients that you mentioned, I'll reiterate, which is the Fed raising interest rates, commercial banks tightening lending standards, and an inflation problem. All of we've had these three issues for about a year now. It takes time for that to flow all the way through into earnings and the labor market. But obviously, the early signs of that it's having an impact, whether it's through the markets last year and tech stocks getting hit, housing fundamentals in the economy getting hit, and now it's flowing into banks. So it's the rate sensitivity flowing from the earliest parts of the economy and financial markets that are susceptible to it. And the end game is ultimately the employment backdrop. And that's for us when a recession starts and looking at the forward-looking indicators of employment, that seems to be something that begins in the middle of this year and becomes the dominant risk for equity markets.
Right. And, I'm sure you saw this, but Bank of America, they put out a note last night, Subrita, saying we're now in late cycle in the downturn phase. Torsten Slok at Apollo this morning saying he's gone from thinking we're going to have no landing to thinking we're going to have a hard landing. So the way I see it, a lot of strategists are kind of catching up with your view and with the warnings you've been putting out there for quite some time. Tactically, for equity investors, what do they do? I mean, we heard earlier last hour about those who believe a recession's coming and are still positioned for the rebound already, that the asset classes that are in sectors that are usually outperforming coming out of that event. Is that something you think investors can be trying to do right now?
Well, it's our job on the sell side as a macro, especially in the macro world, to talk about big picture stories that are coming up. And so, the irony, and it's something I often tell clients, is, I'm not a big believer that the markets are very forward looking. And I think that's been on full display over the last 12 months and increasingly, over the last 12 days, if not 12 hours. And so if you're betting on a recession that's going to happen in 6 months and position for that, 6 months too early, you're going to be wrong. And historically, bear markets really end up in a recession when unemployment claims start to rise. And, ironically, that's also a bit of a problem today because employment is a bit too strong. So, I think we're looking at, we have a framework. We've tried to be remarkably consistent with our views despite the market volatility, which again is commonplace for bear markets. And the catch up that is being made now by other analysts, I think is occurring as we see the lagged effects of this tightening cycle play out. And there's a lot more to come. And so our recommendation to investors at the start of the year, though we have a bearish outlook for year end when employment breaks, is that you want to remain actually somewhat balanced in really high quality companies. And because we believe the market's going to be bouncing back and forth between soft landing hopes and recession fears. And like you just said, Kelly, in the last 6 weeks, we've gone from euphoria. The S&P high beta index was almost at an all-time high to today, in a panic mode.